we want to know liquidity and efficiency. So what is our ability to meet short-term obligations and to efficiently generate revenues? So that the goal there is anything short-term, a year or less generally, how are we going to be able to meet those goals? It doesn't matter. It doesn't matter at all if we have enough, if we expect to generate enough money in 10 years to pay our long-term goals and get rich if we can't pay our debts today. And that's a problem we're seeing right now. This is very relevant in today's market with a lot of the restaurant industry, where maybe these companies on a long-term basis are expecting to be extremely profitable, like Soup Plantation. But if they can't meet their obligations in the next year because no money is coming in, they'll go out of business, right? So even though they have a long-term solvency, you could be illiquid in the current year because they have all of their money tied up in investments. From a personal example, that could be someone you know who's house rich and cash poor, right? So if you don't have any money, even though you currently available, even though you have $300,000 or $400,000 into a house that you have a mortgage on, but if you lose your job and are unable to pay for that mortgage, you have no liquidity, even though you might have solvency. So liquidity, we're talking about these short-term obligations. Are we able to satisfy them? We'll go into that, normally looking at short-term liabilities versus short-term assets or cash. Okay, question. Do horizontal and vertical analysis intercompany analysis tools, or can we use them for competitors analysis? We use them for both. We use them internally. We can compare them against divisions in our own company. I use the example personally, right? We can compare how we're doing if you have multiple jobs, how one job's paying you versus the hours you work versus another company's paying you. So you can use them for yourself, your company, inside the company. You can look at it inside your company over time on a large basis. And then you can look at it from a competitor analysis as well too. So you can look, all of these tools, you can use a competitive analysis, benchmark analysis, internal analysis. So liquidity, good question. So liquidity is, we're really talking about that short-term obligation, and we're seeing a lot of that in the news today, right? Solvency is that ability to generate future revenues and meet long-term obligations. And so this is talking about, in the long run, can my company, am I going to be able to pay off my long-term debt? So this is what bankers look at if you're looking to get a mortgage on your house, or if you take a $400,000 loan for your townhome or your condo in the Bay Area, will you be able to pay that off in 30 years? That's a solvency equation. The liquidity is, will you be able to pay it off in the next month? Oh, maybe you have enough cash to pay it off in the next month, but will you be able to make those payments over the next 30 years is a solvency question. So solvency is those long-term goals, anything over a year. Liquidity is short-term. And companies can be either or both, right? You could be illiquid but solvent. And the perfect example there is the restaurant industry now. We can't meet our obligations today, but if we were to stay in business 5 years from now, we could probably meet all of our obligations. Well, that doesn't matter. If you can't pay your obligations today, you probably have to declare bankruptcy. You can be liquid, but insolvent. So I could develop a business model and have $1 million in the business. I mean, this is very common from a personal standpoint, right? I see this a lot with small businesses where people go and invest $100,000 in a business that doesn't have a lot of potential. And sure, maybe they only owe $30,000 or $40,000 a year, so their company is liquid. They can pay it off in the next year, but it's not solvent, right? If you look and forecast their cash flows over the next 5 years, there's no way that they're going to be able to meet the long-term obligation. Maybe they owe a debt in 5 or 10 years that there's just absolutely no way they're going to meet. They're not solvent. That would also be a cause for potential bankruptcy or to leave a business. Or you could be both liquid and solvent, which is ideal. And that's how a business can move forward. If any of these are an issue, you need to fix it quick. Liquidity, you normally need to fix it through getting loans. You need to fix it through raising capital, through investments. Or finding if you're illiquid but solvent, you need to find a way to raise capital in order to save yourself over the next year. And a lot of companies do this through a lot of different banking agencies like Silicon Valley Bank, Wells Fargo, or they try to raise rounds of investment, right? And that's where you hear like investment banking coming in and investors coming in. Solvency, if you're insolvent but liquid, you need to fix your business, right? So you have enough money to run the next few years, but you can't pay off your long-term obligations. There's something wrong with your business model, and that's normally an even more difficult fix. And if you are both liquid and solvent, then your business can operate as normal. What ties into all of this is profitability, right? And so all of these are separate metrics that we want to assess. Profitability, is the company able to provide financial rewards sufficient to attract and retain financing. And so it doesn't matter at all if I'm liquid and solvent if I'm not making a profit, right? So I know, okay, I can pay my obligations to my short-term creditors. I can pay it to my long-term creditors, but let's say I'm not profitable. So I'm going to try to use an example in industry that you can think about for each one of these. So liquidity, we talked about the restaurant industry and why they're going bankrupt. Solvency, or many are going bankrupt. Solvency, a better example are construction companies, right? If we have in the Bay Area a lot of companies building apartments, and so those companies receive lots of money from banks, tens of millions, hundreds of millions of dollars to build these apartments and then hopefully sell them for a markup. And so these companies will be liquid, but or potentially not solvent if the value of the building goes down. So if those buildings are worth less than the mortgage that they've taken out or the loans from the bank, the company is no longer solvent because they would never be able to pay off those loans. Same thing would happen if you purchased a home and then the home value decreased below your mortgage value, which happened in the previous recession. That'd be a solvency issue that you could never make up for the fact that you owe more than the thing is worth. That happens to a lot of people who take car loans, right? Where you might buy a car that has a $25,000 loan, but if you're to resell the car would only be worth $15,000. That $10,000 difference is a solvency issue. You might be able to pay for it within the next year, but from a solvency, if you sold the car, you would still lose money on it. That's a solvency issue. Profitability, that's where how is the company generating the money from able to generate money and profits in excess of its costs. And so a good example of this is from like a consulting perspective. One of the reasons I enjoy consulting is it's an extremely profitable business, right? So if there's normally very low costs, especially if you don't have an office, and tutoring is a great example of practicing consulting. If you're in college, I highly recommend it if you're looking for work. Anytime tutoring can pay $20 to $50 an hour, then is a good example to kind of get your foot into running a small business. And beside the point, profitability, consulting businesses are generally very easy to be profitable, especially if they're run by yourself, because you have very low costs. And so if you're making $50 an hour and it only costs you $10 an hour in supplies and travel, you're making a profit of $40 an hour. That's high profitability. And if you're able to improve that, you can potentially receive financing from banks and investors who want a piece of that cut as you expand your business. But other companies are very low profitable or are not profitable. And that's in the Bay Area where we're having a lot of issues right now, and why financing is pulling out of the Bay Area is there's a lot of extra money going on trying to get companies to be profitable. You might have heard this with WeWork or SoftBank transactions if you're paying attention to the news. But these companies were, even though they had tons of cash investment, they're liquid and solvent, they had no near future profitability, where they were losing money because their products just weren't interesting to investors. They were paying a lot of money on engineers in order to develop these products, or these products weren't available to customers or interesting to customers. So it doesn't matter if you have the money if you can't make a profit, right? And so that's one of my rules I've said for business right at the beginning is you really don't have a business in my mind unless you're in pharmacies or something, life sciences, very niche business. But most business people, until you have your first sale and you're making a profit, I would say that you're not truly running a true business. And so always focus on profitability. And we'll have metrics to compare profitability across industries. It's very different, right? As you can imagine, grocery stores or coffee stores might have very low profit margins. But then something like consulting might have higher, or software have significantly higher profit margins. It just depends on if it's a commodity, if it's a luxury good, if it's a premium service. And you're going to learn about how all that ties in your economics classes and marketing classes. But this is just a high level overview. And then the last piece we're going to be talking about from a ratio analysis assessment is market prospects. So market prospects is the ability to generate positive market expectations. And so that's going to be market prospects. If I'm a consulting company, can I charge a rate lower than my competitors? Can I offer them something that they don't have? And we'll go over, there's just a few ratios we can go over that can talk about market prospects. We also might be interested in things like market share. We're going to learn this more in marketing and economics. If in the consulting industry, I'm just using this as an example because I'm in it, in the consulting industry, if I know the total market share, the total potential market is $1 billion in the Bay Area, and there's only $100,000 being spent in the Bay Area on consulting, I know that is a very useful metric for me to enter into this market because of the market prospect. But let's say there's $100 million in the Bay Area of market share and $100 million being sold. The only way for me to win business is to fight off competitors. And so that lowers my market prospects. And so it's a harder to generate a positive market expectation. We can see that against guidelines and business analysis and competitive analysis. So I ignore the highlights. I want you to memorize all of these. This is all important liquidity and efficiency ratios. All of the ratios that I talk about today, I expect you to memorize. Memorize for the exam. They're not too complex, but you need to know them. They're extremely useful. And so just flashcard all of these. So all of these are going to be focused on, we're going to be focused on one of each of these buckets: liquidity, solvency, profitability, and market prospects.